This time, it's possible that the money flowing out of regional and local banks flows in part into precious metals because people are looking for safe places to put their money, and their bank is no longer safe. So one of the places that you do go when even your bank can't be trusted is gold and silver coins. So it could be that there's a rise in demand for gold and silver that cushions the effects of a recession on precious metals prices, and that gold and silver actually do just fine in the coming recession. I think it's possible.
The failures of Silicon Valley Bank and Signature Bank have exposed the vulnerabilities of the banking system, even in developed countries. In light of these incidents, some experts are warning that more bank runs could occur, particularly in the face of ongoing global crises such as geopolitical tensions, inflation, and economic uncertainty. As these factors continue to shake the financial world, investors are turning to gold and silver to preserve their wealth. John Rubino, a Wall Street financial analyst, discusses the possibility of money flowing out of regional and local banks and finding its way into precious metals. This shift could be attributed to people seeking secure havens for their funds due to concerns about the safety of their banks. In times when even traditional banking institutions seem untrustworthy, individuals may turn to assets like gold and silver coins as a reliable store of value. This increased demand for precious metals might help mitigate the impact of a recession on their prices, allowing them to remain resilient. When financial institutions like banks, pension funds, and insurance companies hold a significant amount of bonds and real estate assets, they become vulnerable to changes in interest rates. If the Fed increases interest rates aggressively, the market prices of existing bonds immediately decline. New bonds will soon come onto the market, offering investors higher interest rate payments. Rubino emphasizes that this scenario could lead to a financial crisis and severe recession. In such a crisis, individuals might be hesitant to keep their money in troubled banks and could move their funds elsewhere to avoid potential runs and bailouts. The renowned analyst suggests that holding on to core investments in gold and silver could be wise, as they might not suffer as much as in past financial crises. We will now bring you clips from John Rubino's interview with Liberty and Finance. But before we do, if you want more videos like this, ensure you smash the subscribe button and turn on the notifications bell for more videos. Thank you, and enjoy the video.
Financial institutions, like you said, banks, pension funds, insurance companies own a lot of bonds, and they have a lot of real estate exposure of various kinds. Those two things are interest rate sensitive. And if you have the Fed raising interest rates aggressively because they're terrified of what's going to happen if wage growth kind of spreads at 10 or 12% a year for bond prices. When interest rates go up, that's the same thing as saying bond prices go down. So the bonds on the portfolios of financial institutions develop embedded capital losses, which at some point have to be reported. In other words, so these big institutions have to show losses from their bond portfolios, and it makes real estate prices go down eventually when interest rates go up. So you'll see losses being reported by banks and insurance companies and pension funds, which will scare the people who have money invested with those entities and cause them to pull their money out or do other things that hurt institutions like that. And so you'll see a lot of those guys reporting bad numbers, seeing their stock prices fall, seeing money be pulled out. And you'll see runs on them in various ways. That's a recipe for a financial crisis that leads to a really dramatic recession too. We saw something like that back in the housing bubble and bust of 2005 to 2010. And that was brutal for financial institutions. You saw a lot of banks just collapse. A lot of insurance companies saw their derivatives books, of all things, blow up and had to be bailed out. So the same thing could happen this time around if interest rates go up too far, too fast from here. And if wages keep soaring like this, there's a decent chance that interest rates are going to do just that. So that's the one of the financial crisis scenarios that are out there right now, and that's a very real possibility. And basically, the impulse is that if your bank gets into trouble, or a bank similar to your bank gets into trouble, you don't want to be there when there's a run and a bailout and everything. It's just easier and simpler and more restful to take some of your money out and put it somewhere else. So the question is, where does it go? Because we're going to see stuff like that more in the Silicon Valley Bank vein going forward, where banks have to report that they're losing money in their real estate and their bond portfolios. That scares depositors who pull money out, which causes the bank to have to sell some of their bonds at a real loss in order to pay off the depositors, and then the run gets worse, et cetera, et cetera. You don't want to be involved in that. So your impulse will be to take money out of your bank. Where do you put it then? And so here's the scenario in which gold and silver do not get whacked this time in a financial crisis, because normally they go down along with stocks and real estate prices for a while, and then rocket back up when the Fed capitulates and starts easing like crazy. I don't think you should be bailing out of precious metals right now. You want to stay with your core holdings in gold and silver through everything until gold is $10,000 an ounce and silver is $200 an ounce. Your core precious metals should stay your core until this whole thing plays out and reaches its endpoint of a giant monetary reset. But with, for instance, your gold and silver mining stocks and the gold and silver coins you have that aren't part of your core portfolio, then you might want to, kind of think about how you want to play a slowing economy and a banking crisis, et cetera, et cetera. You might actually even want to buy more gold and silver in anticipation. It's just a question of which scenario you think is more likely. And I personally, I have all the gold and silver bullion that I need for this lifetime, I think.
Gold prices touched 5-month lows as the U.S. dollar and Treasury yields gained momentum after recent upbeat economic data added weight to the Federal Reserve's expectations of continuing its tightening policy. According to John Rubino, gold and silver have recently experienced a period of decline, which might be a reaction to their previous performance. However, he sees that the upcoming season tends to favor gold and silver, even though the concept of seasonality affecting stock prices seems counterintuitive. Rubino speculates that if an economic slowdown occurs, central banks worldwide might respond by implementing aggressive easing measures. Due to the substantial global debt load, even a minor recession could threaten highly leveraged financial entities. In anticipation of central bank interventions, investors could be front-running these actions by investing in gold and silver, assuming their prices would rise in response to potential monetary easing. Let's get back to the interview.
Well, gold and silver have had a rough couple of months, and so this could just be a reaction against that. But it's also the case that we're heading into gold and silver's good seasonal time, which is kind of a silly idea when you think about it. Seasonality should not affect stock prices because it's obvious. It's a thing that's right out there, and everybody could front run it, which would kind of short circuit the whole it goes up during this time of year and down during this time of year thing. But it seems to work that way for gold and silver. And the reason for that is that Asian weddings tend to happen in the spring, and Indians and Chinese people especially tend to give gold and silver jewelry as gifts. So that means the jewelers that serve those people have to buy their inventory a little earlier than spring. So it tends to be, in the fall and winter when there's a lot of demand for gold and silver from Asia, which tends to push prices up. Surprised that still works, but it does seem to. And a jump in gold and silver prices during September, for instance, is not unusual at all. In fact, it's kind of normal. So it could be that we're just seeing the beginning of that. Also possible is the idea that if we have an economic slowdown anytime soon here, the central banks of the world are going to have to respond to that pretty aggressively, because we've taken on so much debt that even a modest recession is a potentially existential threat to a lot of over-leveraged financial entities out there. And central banks will want to get ahead of that by easing aggressively as soon as the economy drops into recession. And that's generally good for gold and silver. So it could be that people are kind of front-running the Fed's capitulation out there. Reasonable explanations for gold and silver going up. And we won't know what's true and what's just wishful thinking until right now. I think it seems like a reasonably good time to be in gold and silver and to be adding to positions in precious metals. We got the economy that is showing signs of financial stress and maybe slowing down, but at the same time, you've got a lot of power shifting back to unionized workers and to just workers in general right now. And the airlines are a pretty good example of that. American and United just cut deals with their pilots that call for double-digit wage increases for 4 straight years, with them being front-loaded. Big wage increase to begin with, and then further wage increases that average out to 10 or 11% a year. That's a big deal because the Fed tends not to see rising stock, bond, and real estate prices as inflation. In other words, as something it has to lean against, but it watches wages, and rising wages are considered real inflation by the Fed and the other central banks. So they're liable to react to pockets of the economy with double-digit wage increases as something that's dangerous. They've got to lean against them, that they have to raise interest rates even further to counteract. So let the kind of stuff that's happening with the airlines, for instance, right now, spread to the rest of the economy. And even if the economy is kind of slowing down, you're going to see the Fed feel obligated to stay tighter for longer, which risks catastrophe in this kind of an environment, but which is something they may just have to do because if they don't get inflation under control, then we're going to lose faith in the currency. In other words, we're going to assume that the dollar is going to lose value at an accelerating rate going forward, and we'll act accordingly in ways that are very inflationary themselves. So the Fed knows that it risks losing control of its part of the market if it doesn't stay tighter for longer in the face of high wages. And that's a thing that could happen too. So the short answer to all this is that we've got a lot of cross currents out there, a lot of things happening that point in different directions. And it's not going to be clear until after the fact which ones win out, if any do. And that makes it a tough time to invest, tough time to manage your money, because there are things pointing in one direction and other equally valid things pointing in a different direction.
Bank failures can lead to lost confidence in the financial system. Investors may seek safer options like gold and silver to protect assets as trust melts. For example, during the 2008 financial crisis, numerous bank failures and economic instability led to a significant rise in gold prices. Do you think ongoing banking failures and economic uncertainties drive more investors to turn to gold and silver as safe investments? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.